The crowd never changes, and the market never forgets. That's the first thing I learned when I began my career as a boy scribbling numbers from the ticker tape in the bucket shops. Men would walk in with wide eyes, greedy hearts, and empty pockets. They'd swear to themselves this time it would be different. This time they'd beat the game. But the result was always the same, loss after loss, because they committed the same sins over and over again. And it's those sins I want to talk to you about today. You'll see how every failure on Wall Street is born not out of lack of opportunity, but from the very mistakes traders make with their own hands. Now, before I get into it, I'll remind you of the previous video on why most traders fail, what 90% of traders do wrong. That foundation is important, because the sins I'll be discussing today are the very reasons why 9 out of 10 traders don't stand a chance. These aren't small blunders you make once in a while. These are fatal flaws. Commit them, and your trading career is already over before it begins. Let's start with the first. Impatience. The market does not care for your timetable, and yet most traders act as if the market owes them a quick profit. They buy a stock and expect it to pay off tomorrow. Tell me, have you ever planted a seed and demanded a tree the next morning? That's the same folly. Impatience forces you into trades before the setup is ripe, and it drives you out of good positions before the profit has had time to grow. The tape gives you the signals, but only if you're patient enough to wait for them. If you can't wait, you'll be rushing in and out, leaving commissions for your broker and crumbs for yourself. The second sin is greed. Now, don't mistake me, we're all here to make money, but greed blinds a trader. It pushes him to overtrade, to take on positions larger than his bankroll, to chase a stock that's already run its course. Have you ever felt that itch when your stock is moving, and instead of taking a fair profit you tell yourself, just a little more, just a little higher? That's greed talking. And when greed has you by the collar, the market will snatch back everything it just gave you and more. Then comes hope. Hope is for churches, not for the ticker. A trader who hopes is already beaten. He buys a stock, it goes against him, and instead of cutting the loss, he hopes. He says, it'll come back, it has to, but the market doesn't have to do anything. It doesn't know you exist. I've seen men sit on a losing stock for months, even years, because of that cursed hope. They weren't trading anymore, they were praying. And the market doesn't reward prayers, it rewards discipline. Ask yourself, are you trading the tape, or are you clinging to hope? The fourth sin is ignorance of position sizing. A trader must always know how much he can afford to lose, and he must never risk more than that. But most never bother to think about it. They bet their whole roll on one idea, as if they were sure of the future. Tell me, when has the market ever been certain? Risk too much on one trade, and a single wrong move will wipe you out. The great fortunes weren't made in one stroke. They were built by compounding steady gains and preserving capital. It's not how much you make on a winner that keeps you in the game, it's how little you lose on the losers. Another sin is failing to keep records. This one surprises most new traders. They think trading is about instinct, about the thrill of the moment. But I kept notebooks of every trade, every price movement, every mistake. Do you? If you don't, then you're condemned to repeat the same blunders without ever learning from them. A man who doesn't keep records is like a doctor who never studies his cases. He'll never improve because he never examines the cause of death. And then we come to stubbornness. The market speaks plainly, but many traders refuse to listen. They marry their opinions, they get tied to their forecasts, and when the tape contradicts them, they argue instead of obeying. Have you ever told yourself, the market is wrong, I'm right? That's the voice of stubbornness, and it's the fastest road to ruin. The market is never wrong. Your opinion is what's wrong. If the tape disagrees with you, it's not the tape that must change, it's you. The seventh sin is chasing tips. All across Wall Street you'll hear whispers, buy this, sell that. I learned long ago, the man who gives you a tip has his own reasons. Maybe he wants to unload his shares onto you. Maybe he wants to see if you'll bid the price up for him. A trader who follows tips is like a blind man led by another blind man. You wouldn't give your wallet to a stranger on the street, so why would you give your trading account to some nameless voice with a tip? Study the tape, read the market, and make your own decisions. That's the only way. The eighth sin is failing to adapt. Markets change, conditions shift. A method that worked last year may not work this year. But most traders cling to old habits because it's comfortable. Do you remember in the last video how we spoke about how most traders fail because they keep doing the same wrong thing over and over again? This is the same principle. The market evolves, and if you don't evolve with it, you'll be left behind. I changed my methods many times in my career, not because I wanted to, but because I had to. Adaptability is survival. And finally, the ninth sin, lack of conviction. This is what destroys more traders than you'd believe. They enter a trade half-hearted. They second-guess their decisions. They cut their profits short out of fear. The market demands courage, the courage to sit tight when you're right, and the courage to admit defeat when you're wrong. Without conviction, every trade becomes a torment, and every loss a catastrophe. But with conviction, grounded in study and observation, you can weather the storms and ride the trends that make fortunes. Now, let me ask you something. As you've listened to these sins, how many of them have you committed yourself? Be honest. Because if you've traded for any length of time, you've surely recognized your own reflection in these words. Don't be ashamed, every trader has walked this path. The difference between the ruined gambler and the successful operator is that the successful man learns. He disciplines himself. He roots out these sins from his system. The ruined man keeps repeating them, thinking luck will someday favor him. The market is a stern teacher. It punishes every mistake, but it also rewards the man who listens and corrects his errors. The question you must ask is, will you be the student who learns or the fool who repeats? Failure to adapt is the silent killer of traders. Most men don't even notice it creeping in. They start out in the game, they learn a method, a strategy. Maybe they hit a few winners early, and then they cling to that method as if it were gospel. They carve it into stone, treating it as a law of nature. But the market doesn't work that way. The market is alive. It changes, it breathes, it shifts with the seasons, the moods, the conditions. What worked yesterday may be suicide today. And yet, most traders will keep pressing the same button, pulling the same lever, wondering why the machine no longer spits out coins. Have you ever done that yourself? Sat at the screen, watching your old setup fail again and again, but you couldn't bring yourself to let it go. That's the sin I'm talking about. I learned early in my career that a method isn't sacred. It's only a tool, and when a tool grows dull, you either sharpen it or you replace it. The tape was my teacher, and the tape never lied. I remember in my early days working the bucket shops, I found a system that worked like a charm. I studied the patterns, the price movements, and I made more in a week than most men made in a month. I thought I had discovered the secret. But then the shops caught on. They changed the rules. The trades stopped working, and my winnings evaporated. What would have happened if I insisted on sticking to the same method? I'd have been finished right there. Instead, I adjusted. I found another way. That lesson stuck with me my entire career. The market changes, and if you don't change with it, you're already a dead man walking. Traders love comfort. They like routine. They like believing they've cracked the code. Once they latch onto a method, they hold it as tightly as a drowning man holds a plank of wood. But the sea changes, sometimes calm, sometimes storm, and that plank that once kept you afloat may drag you under when the currents shift. Do you see the danger? It's not that the method itself is wrong. It may have been brilliant in the right environment. But the market doesn't owe you that environment forever. It offers you conditions, and you must mold yourself to those conditions if you want to survive. I've seen bull markets where everything floats upward like a balloon. In those times, almost any fool can make money. Buy anything, sit on it, and the tide carries you higher. But then the bear comes. The same fool who made easy profits in the bull now tries the same tricks, and he wonders why he's bleeding out. He hasn't adapted. He's treating a storm like it's still sunny weather. He thinks his old rules apply, but the market has rewritten the rule book. How many traders do you think go broke because they can't make that shift? Too many to count. Now let me ask you directly. Are you watching the market, or are you only watching your own method? Because there's a difference. Watching the market means you observe how conditions change, how volume behaves, how trends start and end, how momentum dries up or accelerates. Watching your method means you're staring at the same signals, hoping they still work, even when the market is screaming otherwise. Hope belongs in churches, but it has no place in trading. If the method fails under the current conditions, you must adapt. You must shift your sails, not argue with the wind. Adaptability isn't about throwing away everything you know each time the market turns. It's about refining. It's about having principles that never change, like risk control, like patience, like discipline, but adjusting tactics around those principles. For example, in quiet markets where ranges are tight, a breakout strategy may leave you bleeding from 1,000 little false starts. But in a roaring bull, that same breakout method might make you fortunes. Do you see the point? The principal buying strength stays the same, but the timing and the execution must shift with the conditions. A rigid trader can't make that adjustment. A living trader can. I remember one campaign in particular where adaptability was the only reason I survived. The stock had been trending beautifully, climbing in a clean line. I was adding to my position as it confirmed, and the profits stacked higher. Then, almost without warning, the character of the stock changed. The volume dried up, the swings became erratic, and the clean rhythm was gone. Now, I could have insisted on staying, telling myself the trend was intact, but the tape was different. It was telling me the story had changed. So I stepped out. I booked my profits. A few days later, the stock collapsed. If I had clung to the old conditions, I'd have given it all back. But by adapting, by listening to the new language of the tape, I kept what I had earned. Every trader must ask himself, am I willing to change when the market demands it? Most aren't. Pride gets in the way. Pride says, my method is correct, the market will come back to it. But the market doesn't care about your pride. It doesn't even know you exist. All it does is change its tune, and the question is whether you're nimble enough to dance to it. I've seen brilliant men with better brains than mine, fail simply because they were too proud to adapt. They'd rather go down with their theory than admit the tape had changed its mind. Tell me, is that trading, or is that suicide? And adaptability isn't only about market conditions, it's also about your own growth. The trader you are today should not be the trader you were last year. Each campaign teaches you something new. Each mistake adds to your education. If you're still trading exactly as you did 5 years ago, what does that say? It says you've learned nothing. It says you've been stagnant, frozen in time, while the market marches forward. Growth demands change, and change demands adaptability. Another point worth remembering, the market has cycles just like nature. Bull, bear, consolidation, panic, euphoria. Each requires a different mindset. In a bull, you must learn to sit tight, to ride your winners and let them run. In a bear, you must learn to cut quickly, to short with conviction, or to stay out altogether. In a sideways market, you must learn patience, to wait for the real break instead of chasing shadows. Each season has its strategy, and if you try to play them all with the same rules, you'll be out of step. Are you tailoring your actions to the season, or are you wearing summer clothes in the middle of winter? Adaptability also applies to position sizing. In volatile times, when the swings are wild, it's suicide to trade the same size you would in calmer markets. You must scale down, protect capital, wait for clarity. But when the market is trending cleanly and predictably, that's when you press harder, pyramid your position, ride the tide. To treat every market the same is to misunderstand the very nature of the game. The size of your bet should adapt just as much as the timing of your entry. Now think about this. How many traders do you know who have blown up accounts because they couldn't adapt to volatility? They traded heavy in stormy seas as if it was still calm waters. The same wave that could have been a small loss became a catastrophe. Adaptability isn't a suggestion, it's survival. Even your mindset must adapt. In losing streaks, Humility is your best ally. You trade smaller, you observe more, you rebuild confidence. In winning streaks, confidence must expand, but never into arrogance. You adapt not just to the market, but to your own psychology. You must know when to press and when to retreat, when to stay in the fight and when to step aside. The hardest part is letting go of something that used to work. Traders fall in love with their methods. They romanticize them as if they were old sweethearts. But the market doesn't care about your romance. If the method fails, you must cut it loose. Clinging to it out of nostalgia is as deadly as clinging to a losing stock out of hope. Are you guilty of that? Holding on to a strategy long past its expiration date, because you can't accept it's no longer valid? I've always said, the only thing you can depend on in the market is change. Prices change, trends change, sentiment changes, everything changes. If change is the only constant, then adaptability is the only true edge. The man who can bend with the market, who can shift when the wind shifts, is the man who survives. The man who resists, who digs his heels into the ground, is the man the market tramples. Hope is the costliest emotion a trader can carry into the market. It sneaks in quietly, dressed as patience, but it's not the same thing. Patience waits for the right moment before acting, but hope clings to a mistake after the moment has already passed. When you place a trade and it goes against you, there are only two choices: cut the loss or let it grow. Hope whispers in your ear and tells you to let it grow. It says, don't worry, it'll come back. But the market doesn't owe you a comeback. The market doesn't even know you're in the game. Have you ever found yourself staring at the screen, praying that a red number would turn green, as if your prayer could shift the tide? That's hope, and it's the ruin of traders. When I was young, working in the bucket shops, I'd see it daily. Men would rush in, buy on impulse, and when the tape ran against them, they didn't sell. They froze. They hoped. I watched them sit with their jaws clenched, watching the numbers tick further and further away from their entry. They told themselves stories about why the stock was bound to rebound. Stories about how they couldn't possibly be wrong. Stories about tomorrow making everything right again. But the tape didn't listen to their stories. The tape kept writing its own. And by the time hope had finished whispering in their ears, their accounts were already emptied. The trouble with hope is that it blinds you to the truth the market is telling you. The tape is like a mirror, showing you exactly what is happening. But when a trader is full of hope, he doesn't look at the mirror. He looks at the picture in his head of how he wants things to be. Which do you think is more powerful, the reality of the tape or the fantasy in your head? Yet traders side with the fantasy, every time. Hope convinces a man to hold on to losers, but never to hold on to winners. Isn't that strange? When a stock is rising and the profit is real, hope doesn't say, sit tight, let it grow. No, it says, take it now before it slips away. That same hope that makes him cling to his losses forces him to cut his winners short. And that is how a trader destroys himself: big losses, small profits, and a constant churn of wasted effort. Ask yourself honestly, how many times have you sold a good stock too early because you hoped to protect a small gain, while at the same time sitting stubbornly with a losing position because you hoped it would come back? The market punishes hope because hope has no discipline. Discipline says, the tape is against me, I'm out. Hope says, one more day, one more point, one more chance. Discipline takes a small loss. Hope takes a large one. Discipline respects the market. Hope argues with it. And no trader can win an argument with the market. The market has more patience than any man alive, and it will wait until your capital is gone. I recall a campaign where hope almost had me by the throat. I was long in a stock that had treated me well before. It had made me good money, and I believed in it. But then the character of the tape shifted. The support levels cracked, the volume changed, and every signal told me to get out. Did I? Not right away. I told myself, it's just a shakeout, it'll rebound. This stock has always come back before. That was hope talking, not my judgment. For 2 days I sat watching it sink further, my pride chained to my position. Finally, I cut it loose. The loss was larger than it should have been, but not fatal. A week later the stock was 20 points lower. If I had held on, hope would have buried me. That experience drove the lesson deep the moment I catch myself hoping. I know I'm in danger. Hope is rooted in fear. Fear of being wrong, fear of losing money, fear of admitting a mistake. But in trading, mistakes are inevitable. No one wins all the time. Even the best setups fail. The difference between a seasoned operator and a ruined gambler is not whether they're wrong, but how they handle being wrong. The seasoned operator accepts it, cuts it, moves on. The ruined gambler hopes. He refuses to admit error. He clings. And in clinging, he drowns. Which one are you? The man who accepts the loss, or the man who drowns in hope? It's important to understand that hope feeds on memory. A trader remembers the times when a stock did come back. He tells himself, I've seen this before, it'll turn around again. But memory is selective. He forgets the times when it didn't come back, when it went to the bottom and never returned. A stock can go to zero. Companies collapse, trends reverse, fortunes vanish. And yet traders act as though the market is obliged to restore their losses. That belief is nothing but expensive hope. Even professionals fall into this trap. I knew operators with large bankrolls, seasoned veterans, who were undone by hope. One man I knew had built a fortune shorting in a bear market. When the tide turned and the bull returned, he kept shorting. Each time he was wrong, he told himself, the bear will come back, it has to. Hope convinced him to hold his shorts as the bull trampled them. His fortune melted, not because he didn't know how to trade, but because he couldn't let go of his hope that the market would return to the conditions he understood. The truth is simple. Hope cannot change the tape. The only power you have is over your own actions when you buy, when you sell, how much you risk. The moment you surrender that power to hope, you've abandoned the one thing you control. You've become a passenger, not a trader, and passengers don't last in Wall Street. Cutting losses is the antidote to hope. A trader who cuts losses quickly doesn't need hope, because he never lets a position trap him. He can always re-enter if the tape turns back in his favor. But once you start hoping, once you let a loser grow, your hands are tied. You can't think clearly, you can't act decisively, because your judgment is chained to the outcome of that one position. Have you ever felt that paralysis? That sick feeling in your stomach, knowing the position is bad, but unable to close it because you're still hoping. That is the weight of chains you put on yourself. Another angle to this is how hope affects your money mindset. A trader with the wrong mindset thinks of the market as a place to prove himself right. So when he's wrong, he hopes for redemption. But the market is not a judge of your worth. It's just a place where prices move. The right mindset says, I'll be wrong often, but I'll keep my losses small. The wrong mindset says, I must be right, and the market will prove it if I just wait long enough. Which mindset do you think survives? Hope also destroys time, and time is capital. Sitting on a dead position ties up money that could be working for you elsewhere. While you hope for one loser to recover, other stocks are moving, opportunities are passing, trends are unfolding. You miss them because you're stuck, your capital frozen in a hopeless bet. The opportunity cost is enormous. A trader who cuts a loss quickly has fresh capital ready for the next opportunity. A trader who hopes has nothing but regrets. You'll notice that the greatest fortunes in Wall Street were made not by hoping, but by sitting tight on winners. That requires conviction, not hope. Conviction comes from reading the tape, seeing strength, and trusting the position. Hope, on the other hand, is born from weakness, seeing a loser and begging for relief. Do you see the difference? One is grounded in evidence, the other in fantasy. Hope is seductive. It feels easier than admitting you were wrong. It promises comfort in the short run, but in the long run, it costs everything. A trader must train himself to recognize the moment hope enters his mind. That's the signal. That's the alarm bell. The moment you hear yourself saying, it'll come back, you already know what must be done. Position sizing. It's a term that sounds simple, almost mechanical, but it is the cornerstone of survival in the markets. I've watched more men fail because they ignored this principle than for any other single reason. They enter trades without thinking about how much of their capital is at risk, as if the market was some magic machine that only rewards bravery. But the market doesn't reward bravery, it punishes recklessness. Ask yourself this: how much can you afford to lose on a single trade? And don't answer with hope or wishful thinking. Answer with cold calculation, with discipline. That is the difference between a man who survives to trade another day and one who disappears into the ledger of ruin. I remember early in my career, I saw a young man come into the bucket shop with a roll of cash he claimed was his life savings. He had studied charts, he had read the papers, he had even listened to tips whispered on the street. He bought a stock that moved fast, and without a thought to how much he could lose, he loaded up. At first, it moved in his favor. His chest swelled, he felt invincible. Then the tape turned against him, just a little at first, a few points. But because he had risked too much, that few points were enough to blow him out. One trade, and he was gone. That's position sizing. Even a good idea can kill you if you bet too much. Even the best setup can destroy your account if you refuse to measure how much is at stake. Position sizing isn't about greed, it's about survival. I've seen men take a winning streak as a license to increase the size of every trade. I'm on a roll, they say. I can risk more now. But the market doesn't care about streaks. It only cares about conditions. One wrong turn, one false signal, one unexpected move, and that streak becomes a string of losses that wipes out all the gains and more. The trader who increases his risk without thinking is dancing on the edge of a cliff, thinking he can fly. Do you see the folly in that? The right way to approach position sizing is like tending a garden. You plant only what you can afford to lose. You give each trade its space. You allow room for growth, but you never overcommit. If the trade moves in your favor, you reap the reward. If it goes against you, the loss is tolerable, and you live to fight another day. Traders who ignore this principle act like gamblers rolling dice with the entire bankroll on each throw. They might win once, twice, maybe 3 times. But eventually, the law of averages catches up. The market always collects its toll from those who risk too much. I've often said, and I'll say it again, survival is the first rule. Profit comes second. You cannot make money if you don't survive to make it. And position sizing is survival. It's the principle that keeps you in the game when the market turns. Without it, you are prey to every fluctuation, every rumor, every unexpected twist. Even the best analysis, the most flawless execution, cannot save you if you risk too much. Consider leverage. The young man in the bucket shop could have used leverage, borrowed money to double or triple his position. Most would think this is a shortcut to wealth, but leverage is simply a magnifier of mistakes. If you position yourself correctly with your own money, you can take a loss and still live. But if you magnify that loss, you magnify your risk of ruin. Many men, convinced of their brilliance, fail not because they are wrong, but because they didn't respect position sizing. The market is always ready to teach this lesson, sometimes brutally. Even experienced traders are not immune. I knew a man who had made a fortune in a bull market. He had a keen eye, read charts better than most, and understood trends with uncanny precision. But one day in the heat of a strong rally, he added too much to a position, convinced the trend would carry him further. The trend reversed slightly, and suddenly the margin on his position was too high. Within hours, a fortune evaporated, not because the trend was wrong, but because he had risked too much of his capital. Position sizing could have protected him, but arrogance and overconfidence blinded him. It's not just the total amount at risk, either. It's also about knowing the potential loss of each position relative to your total capital. Some trades are more volatile than others. Some carry hidden risks. A stock can gap down overnight, a rumor can move the tape, and a single swing can wipe out months of careful profits. Proper position sizing accounts for this. It allows for the natural volatility of the market. It protects your account from normal fluctuations, so you can ride out temporary swings without panic. A trader must also learn to adjust position size depending on the market conditions. In calm markets, perhaps you can press a little more aggressively because the swings are manageable. In choppy or highly volatile markets, smaller positions are essential because the unexpected can come from any direction. Do you see why discipline in sizing is more important than a clever system? A brilliant strategy cannot survive reckless sizing. No system can save a trader who ignores the risk of a single trade relative to his overall account. Many men fall into the trap of thinking they are skilled enough to overcome large positions. They tell themselves, "I've been trading long enough. I know what I'm doing." But the market doesn't care about experience when the numbers are stacked against you. A well-timed trade with reckless sizing can ruin a lifetime of careful work. Position sizing is a safeguard, a way to ensure that no single event, no sudden drop, no unexpected news, no false signal can destroy everything you've built. Another part of position sizing is knowing when to cut a position. Even if you enter correctly, the trade can go wrong. Perhaps the market conditions change, perhaps an external factor disrupts the trend. If your position is sized correctly, you can exit without panic, without devastation. But if it's too large, the fear of loss can cloud judgment. You may hold on too long, hoping to recover, and that hope becomes your undoing. Position sizing isn't just about protecting capital. It's about protecting your mind, keeping fear and hope from dictating your actions.